Welcome to our reading on financial analysis techniques, and really you can read that as being ratios. Okay, our first LOS is describe tools and techniques and their limitations. So when we're looking at ratios, we can use cross-sectional analysis. In other words, comparing our company's ratios to other companies within the industry, or maybe industry norms or averages. Or we can use time series, where we can look at how our company's ratios change over the time. Now remember, ratios don't answer questions, but typically they give the analyst information to ask the right questions, i.e. they identify the questions that the company needs to answer. Let's have a little look at a horizontal common size statement. Up until now we've seen vertical common size statements where essentially in the income statement each item was shown as a percentage of sales, and in the balance sheet each item was shown as a percentage of total assets. Here we're seeing a common size horizontal statement. What you do is you have each year shown relative to some base year. So in year 1, notice all the balances are 1. Then you can see in year 2 we're looking at our accounts receivable relative to year 1. So it says 1.3, telling us our accounts receivable was 30% higher, and then in year 3 you can see they're back down to 1, so they fall back to their original level. Purpose of this, of course, is trend analysis. Graphs, well, of course, graphs give you a visual representation of what is happening to the company. They allow you to look at performance, they allow you to look at financial structure. Okay, now the types of graph that we need to be aware of is a pie graph. Nice for the balance sheet because you could look at assets maybe and split it up into composition of total value, or you can look at stacked column graphs where you can look at how total value is changing over time, or line graphs that show you changes over time. So let's have a look at some of these. Here's our stacked column graph. You can see we appear to be looking at payables, lease obligations, cash and long-term notes. So it's giving us some idea of our liquidity, if you like, in this particular case, and you can see how each component is changing over time. So you can see that we didn't seem to have any lease obligations until 20X6, and then they've grown considerably since then. But you can see as well that the cash balances for this company are dropping over that period. So it just gives you a nice representation over time. Now, of course, what you could do is look at each item on a line graph that really shows you the trends in a much more obvious way. So you can see that there's our cash declining over time. You can see our lease obligations starting in X6 and then increasing over time. You can see our long-term notes changing, etc. So it really does show you changes over time. Now, we need to be aware of the limitations of ratios. Now, of course, a ratio tells us nothing in isolation. We need some form of benchmark to compare it against. And we've already said this could be cross-sectional, comparing to other firms, or it could be time series, comparing to our firm's ratios and looking at how they've changed over time. Now, remember, if you're using cross-sectional, then you've got to be aware of different accounting treatments. In other words, different accounting principles that have been selected by two firms reduce their comparability. Now, of course, this is especially the case when you're comparing one firm that uses US GAAP and maybe one firm that doesn't. So when you're looking at international analysis. Now, for certain firms, it's very difficult to find comparable industry ratios. It's very difficult to find benchmarks. And what I'm really thinking about here is conglomerates. Now, a conglomerate, of course, is a firm that works in a multiple industry. Let's think of Richard Branson's Virgin. What have you got there? You've got Virgin Airlines, Virgin Trains, Virgin Financial Services. My favourite one is Virgin Brides, so it's just bridal wear, but it's a nice idea, isn't it? So you've got all of these different business entities. Now, the problem is, when you look at the balance sheet and income statement, you're seeing them for the entire group. Now that gives you a problem, because the only way therefore that you could find meaningful benchmarks to compare the ratios to is if you could find identical companies that have the same business operations, but not only would they need the same business operations, they'd need them in the same proportions as your firm. Now, of course, one saving grace is if you do have a firm with lots of different business operations, then there's likely to have to give segmental disclosure in its footnotes, and we'll talk about that later. Ratios must be viewed relative to one another. In other words, if one ratio changes, what does that tell you about your expectations of another? We'll have a little look at that later, in particular with DuPont. And then finally, of course, ratios are relative measures. So essentially determining what a good ratio is requires some kind of judgment call by the analyst and a range of acceptable values. Okay, so know your limitations. Common size statements, well, I think we've done this one to death. We know our typical vertical common size statements show everything in the balance sheet as a percentage of assets, everything in the income statement as a percentage of sales, and of course then it will allow you to analyze changes in cost structure and profitability over time in particular. Okay, so let's just have a little look at example that. We've got a common size income statement, and look, it shows us that cost of goods sold were 58% in X7 of sales. They're now 62% in X8 compared to 60% industry average. You can see sales general admin was the same as industry averages in X7, but is now 22% in X8. And you can see our net income has been below industry averages and appears to be declining. So, what can we tell from this? Well, you can see that we've got an increased cost of sales percentage. Now, this either means we're selling less, or selling at a lower price, essentially, I should say, or the cost of producing our goods and services has increased. Now notice we've got an increased sales general and admin percentage. So again, this could either indicate a lower selling price again, i.e. sales revenues fallen, or alternatively, higher costs. Maybe our sales general and admin costs are starting to spiral. A lower net profit margin, of course, either reflects lower sales figures due to lower sales price, or alternatively, higher expenses. Next LOS, classify and calculate categories of ratios. So we're going to need to be able to calculate activity ratios that tells us how efficiently our firm is operating in its day-to-day activities, liquidity ratios that look at its ability to meet short-term liabilities as they fall due, solvency ratios that look at their ability to meet long-term obligations, in other words it's looking at the capital structure, profitability ratios that show us how we generate profits from our sales and assets, and then finally valuation ratios that we can be used to value a company, such as price earnings, etc. Now, ratios hugely common in the exam. In particular, the examiner likes to test other areas of the syllabus, so maybe let's say percentage of completion versus completed contract, in how they would affect potential ratios. So you really, really need to be strong on your ratio calculation. Okay, so putting it into some form of context first, when we're computing ratios, we need to have a look at those ratios. Do they fit with the company's goals and strategies as described in the management discussion and analysis? We then need to compare our company's ratios with industry norms. In other words, ratios can be industry specific. What looks like a bad ratio in one industry might be a good ratio in another. We've talked about the multiple lines issue before. If we've got conglomerate companies, then of course we're going to need to use segmental disclosure to compute our ratios. And we know, of course, if we're comparing between firms, then accounting methods, accounting principles chosen will reduce comparability. Economic conditions, of course, well, of course, our ratios will fluctuate over time due to the business cycle, booms and busts, and we need to take those into account when interpreting our ratios. So let's have a little look at some rules before we get into the computation of our ratios. So if we're looking at items that are ratios that are pure income statement ratios, then we just use values from the current income statement. If we look at a ratio that is a pure balance sheet ratio, meaning the numerator and denominator of our ratio both come from the balance sheet, then we can use values from the current balance sheet. However, if we have mixed ratios, which means maybe the numerator is from the income statement, the denominator is from the balance sheet, or vice versa, then no, we should use average values from the balance sheet items if we can, if we've got enough information to compute them. Why? Because the income statement is dynamic. Remember, it spans the period between two balance sheets. Therefore, if you only were to look at the year-end balance sheet figure, you'd be comparing something that had been generated over an entire year to something right at the year-end. You get a distortion. So it's better to use average values for your balance sheets when you're looking at a mixed ratio. Okay, so first things first, let's look at our activity ratios. First one is inventory turnover. This is cost of goods sold divided by average inventory. Remember, COGS is from the income statement, so we use average inventory. What does it tell us? Not a lot. I guess it tells us how many times we run down our inventory and need to repurchase during a year. I think days of inventory on hand are more useful. Notice this is 365 divided by inventory turnover. This will tell you the length of time between receiving raw materials and selling finished goods. In other words, the raw material holding period, the production period, and the finished good holding period, all combined in one. You can separate them out, but that's not in our syllabus. Receivables turnover, which is essentially sales divided by average receivables. I guess it tells us how many times we collect the cash from our customers in a year. Again, it's more useful to use 365 divided by receivables turnover because that tells you the length of time in days between selling a finished good and collecting the cash from your customer, i.e. your credit collection period. Payables turnover. Notice this is purchases, not cost of goods sold. Now you may need to calculate purchases. Remember, cost of goods sold minus the change in inventory, cost of goods sold less an increase in inventory or plus a decrease in inventory gives you, of course, your purchases figure. So purchases divided by average accounts payable gives you your payables turnover. Again, what's more useful in terms of interpretation is the number of days payables that tell you the length of time between receiving raw materials and paying your suppliers. Working capital turnover, I'm not sure this is that exciting, shows you, notice revenue on your numerator, average working capital on the denominator, so showing the sales that you're generating from your working capital. Notice our definition of working capital is current assets minus current liabilities. Some other activity ratios: fixed asset turnover, sales over average net fixed assets. They say net fixed assets, they just mean net of accumulated depreciation. That's all they mean. So in other words, the carrying value of fixed assets. Now, of course, this is showing you the sales that you're generating from your fixed asset base. So it's a kind of volume ratio. What volume of sales are you generating from your fixed assets? And then finally, total asset turnover, sales over average total assets. So it's saying the total assets, this is what you've got to use in your business. How are you generating sales from those assets? Liquidity ratios. Probably the most famous liquidity ratio is current assets over current liabilities. Argument here is saying if current liabilities were greater than current assets, there may be a problem with liquidity. Again, you can't tell for certain. You'll need to combine it with the cash operating cycle. Quick ratio recalculates the current ratio, but it ignores inventory. The argument is inventory is fairly illiquid. First of all, you have to produce the goods, then you have to sell the goods, then you've got to collect the cash from your customer. So all it does is it reworks the current ratio, ignoring inventory. Sometimes also known as the acid test ratio. Finally, we have the cash ratio that takes cash and any short-term marketable securities. We're saying they're as good as cash because you could phone up your broker and sell them, and 3 days later the cash would be in your account. So cash and marketable securities over current liabilities. Okay, defensive interval ratio. Notice this takes our cash, short-term marketable investments and receivables, so really everything other than inventory, and divides by daily cash expenditure. It gives you an indication of how long the company could continue to operate if no new cash was incoming to the company, no new assets were generated by the company. Now, one of our key ones is the cash conversion cycle, which you often have to calculate in the exam. And it's computed as days of inventory on hand, plus days of sales outstanding, minus the number of days payable to get the cash conversion cycle. Well, let's have a look at exactly what it is. So, raw materials arrive in the company, production commences, and production is complete. And then finally we actually sell the goods. Now that, of course, is the days of inventory on hand. Now, we sell the goods normally on credit, and we'll have to wait for some time until we receive the cash. And of course, that's the days of sales outstanding. So if you take the days of inventory on hand plus the days of sales outstanding, you have the length of time between receiving raw materials and collecting the cash from the customer, the cash operating cycle. Now, the time taken between receiving raw materials and paying our suppliers are the number of days payable. Now, significantly, we want the length of time between paying our suppliers and collecting the cash from our customer, which is the cash conversion cycle. Now, of course, for many manufacturing firms, they'll pay their suppliers long before they collect their cash from their customer. Okay, so in other words, this cash conversion cycle needs to be financed. And what that tells us is a company that has a cash conversion cycle like this, where they're paying suppliers before receiving cash from the customer, could not support a current ratio below 1. So its current ratio would have to be above 1. Now, if you look at a company like a supermarket, often you'll find that their cash conversion cycle is very, very much different. In other words, they receive the cash from their customers before they pay their suppliers, in which case they can support current ratios that are less than 1. Let's turn our attention to our solvency ratios now. And we talk about business risk and financial leverage. Business risk is the variability of your operating profits, and your variability of operating profits come from two sources: the variability in sales, i.e. sales volatility, and operating leverage. Operating leverage is the amount of fixed costs, or the proportion of fixed costs in your EBIT. The more fixed costs you have, the more volatile operating profits will be, because of course as sales fluctuate, fixed costs don't. Financial leverage is all about the introduction of even more fixed costs when you lever up, when you introduce debt to the company. Now, of course, when you introduce debt to the company, the fixed cost that you introduce is interest. Remember, our definition of a fixed cost is anything that does not vary in line with sales. So if you had a company that had a high level of operating leverage and then it was to leverage up, you would get very, very volatile earnings. So financial leverage is looking at the additional interest added to the income statement as a result of your gearing, your leverage. So let's have a look at some of our solvency ratios. First one we need to know is our total debt ratio, otherwise known as the debt to asset ratio. Simply total debt over total assets. Now, what is total debt per our exam? It's interest-bearing current liabilities and any long-term liabilities. Okay, so it's all long-term liabilities but only interest-bearing current liabilities. So the total debt ratio is debt over assets. Okay, now debt to capital ratio, which of course is a common ratio, total debt over total debt plus stockholders' equity. So it's debt over debt plus equity. So it's showing you the proportion of debt, the percentage of debt in your capital structure. Debt to equity ratio, which should just be 1 plus the debt to capital ratio, is total debt over stockholders' equity. Financial leverage ratio, and we'll see this in DuPont analysis in a little while, is our average total assets over our average total equity. Now, the basic idea here essentially is as you leverage up, as you purchase assets using debt, assets are going to increase, equity won't, so the ratio starts to climb above 1. Interest coverage ratio, a very common ratio to calculate. EBIT over interest payments, and it's simply a safety ratio. It's looking at how comfortably you're meeting your interest payments. Fixed charge coverage looks at all fixed payments that you legally have to make, so it looks at lease payments as well. So it takes EBIT, it adds back lease payments, essentially. That would be the interest on finance lease, or of course the rental payment on an operating lease, and then divides by interest payments plus any lease payments. Profitability ratios. Gross profit margin, we've talked about this before. Remember, we said you'll see this on the face of a common size income statement. It's simply gross profit, which of course is sales minus cost of goods sold, over your revenue. Operating profit, EBIT over sales. Now remember, EBIT is an approximation of operating profit. There's no strict accounting definition of operating profit, really. And the problem with EBIT is it contains some non-operating items such as dividends received, gains and losses on disposal of investments, etc. Pre-tax margin, yeah, okay, so it's earnings before tax over sales. Not very excited by that. Net profit margin, of course, very common, and again on the face of a common size statement, net income over sales. How do we generate net income from our sales? Other ones that we should be aware of are return on assets, which is net income over average total assets, showing you how you generate earnings from your asset base. Bit of an odd one this though, because assets are funded by debt and equity, but net income only belongs to the equity holders. So you could do an alternative calculation where you take net income and add back net interest. That way you've got the returns for both debt and equity holders, and put that over average total assets. Remember, average total assets, by definition, total assets equal liabilities plus equity. So you've got the total returns to both debt and equity holders on the numerator, and then a measure of both debt and equity on the denominator in the alternative calculation. If the examiner just says calculate return on assets, I would always compute net income over average total assets. Operating return on assets is just operating income over average total assets. Remember, we'll use EBIT typically as a proxy for our operating income. Return on capital. Short plus long-term debt and equity, so any interest-bearing current liabilities plus long-term debt plus our stockholders' equity, and we're looking at EBIT. Now EBIT's good because it's a pre-levered measure of return, so before any distributions to both equity and debt holders. One downside of using EBIT is it's also before tax, and of course the returns to both debt and equity holders are after tax payments. Return on equity, net income over average total equity. Looking at how essentially the returns that we generate on our equity holders' investment in the company. We're going to take ROE in just a little bit and break it down into its component elements using something called DuPont analysis. Return on common equity, just as well, actually total equity could include preferred stock. So let's take any preference dividends away from our net income, and then let's take any preferred stock essentially out of stockholders' equity. Next LOS says describe and evaluate the relationships amongst ratios. So of course what we've already said is if one ratio moves, what does that tell you about your expectations of other ratios? So we need to analyze all ratios collectively. One ratio, in other words, using one ratio maybe to answer questions raised by another. And our most classic example of this is something called DuPont analysis, which we will be doing later. It's an absolute examiner's favorite, DuPont. Okay, so let's have a little look at this integrated technique. So we've got a company here. We can see that its current ratio has been worsening over, it's been improving. I'm looking at the numbers in the right order. X6 is 1.2, X7, 1.5, X8, 2. And remember, the current ratio is current assets over current liabilities. But notice its quick ratio has been worsening over time. Remember, the only difference between the current ratio and the quick ratio is inventory. Inventory is not included in the quick ratio. Straight away, by looking at those figures, if the current ratio is improving but the quick ratio is worsening, it would indicate therefore to me that the company must be building up its inventory levels. Now let's have a look. Do the days of inventory on hand suggest that that is the case? Yes, of course it does. Look, they were 30 days of inventory on hand, they're now 60. Let's have a look at days of sales outstanding. Was 40, now 20. It looks like our firm is improving its credit collection. So let's have a look. Current and quick ratio. Current ratio up, quick ratio down. Why would that be the case? Well, we've already said it indicates rising inventory levels. Now, the fact that days of inventory on hand have increased, again, give us further evidence of this. Days of sales outstanding have decreased, indicating we're collecting cash from our customers sooner. So if we're collecting this cash sooner, what are we using it to do? Well, of course, it is buying inventory. Okay, so it appears that the company has improved the cash collection from customers and is using it to make up for poor inventory management. Well, hang on a second, that's a bit of a jump. They might be building up their inventory levels because they think that sales are going to increase in the future. Of course, one interpretation could be that they've got poor inventory management. Right, let's turn our attention to DuPont. It says demonstrate DuPont, absolute examiner's favorite. So what we're going to do is take our return on equity, which is net income over, really it should be average equity, and we're going to split it down into component parts. We could look at net income over average total assets, which is return on assets, and look at total assets over equity, which is the financial leverage multiplier. So in other words, we're saying if return on equity is changed, is it because we're not as efficient in using our assets to generate income, or is it because our leverage has changed? Now here is our classic three-stage DuPont. So again, we're taking our net income over average equity and splitting it into net income over sales, net profit margin, and revenue over equity, equity turnover. Now, equity turnover can be further broken down into asset turnover and the financial leverage multiplier. So now if ROE changes, we can say, is it due to changes in our net profit margin? Is it due to changes in our efficiency of using our assets to generate sales, asset turnover, or is it because we've changed the leverage of the company, the financial leverage multiplier has changed? Now, we're not getting a lot of information in the income statement. In our three-stage DuPont, we're just seeing net income over sales. So what we can do is break down that and move to five-stage DuPont. And we can look at EBIT over sales, operating profit margin. And notice whatever was the numerator in the previous calculation is going to become the denominator on the next. We could look at, so operating profit margin, as we mentioned. We could look at EBIT over earnings before tax, the difference between those two figures being interest, so it's the interest burden, and earnings before tax over net income, and the difference between those two figures, of course, is tax burden. So now, if the net profit margin changes, we're saying to ourselves, is it because of our operating profit margins changing? Is it because we've got more fixed interest in the income statement, or is it because we're paying more tax? So notice therefore, five-stage DuPont is operating profit margin times interest burden times tax burden, which is just 1 minus your effective tax rate, where the effective tax rate is tax expense divided by profit before tax, times asset turnover times your financial leverage multiplier. Make sure you know both three-stage and five-stage DuPont for your exam. It will be there, it always is. Next LOS, calculate and interpret ratios that are used for equity valuation, credit valuation, etc. So here are a few of our classics: price earnings, price cash flow, price sales, price book value. When they talk about book value per share, note that it is the book value of equity. Okay, so the stockholders' equity divided by the number of shares. I'm not going to go into any detail with these here with you because they're all repeated in far more detail in equity, of course. Per share quantity, basic EPS, we've done this before. Profit attributable to your common stockholders divided by the weighted average number of shares. Diluted EPS, of course we make the adjustment for dilutive securities. Cash flow per share, and we've seen this as well, CFO divided by your weighted average number of shares. So we've seen all these ratios before. EBITDA per share. EBITDA is earnings before interest, tax, depreciation and amortization. Argument is depreciation and amortization are non-cash items, and in addition they tend to be quite volatile, so EBITDA tends to be closer to cash and less volatile than EBIT. So they're looking at EBIT essentially over the number of ordinary shares. Dividends per share, common dividend divided by the number of shares in issue. Dividend payout ratio, common dividend divided by net income minus preference dividends. Now that's the dividend payout ratio. What we're looking at there is the dividend paid to the common stockholders over the profit that was available to distribute them, the net income attributable to them. So it's showing you what percentage of your earnings are you paying out by way of a dividend to your common stockholders. Now the retention rate has to be 1 minus the dividend payout ratio. If we're retaining 60%, if we're paying out 30% of our earnings by way of a dividend, then by definition we're retaining 70. So it's net income attributable to the common stockholders minus the common dividend over the net income attributable to the common stockholders. Notice the only difference from your numerator and denominator is the common dividend. So the retention rate is the percentage of earnings that are being reinvested in the company and added to our retained earnings. Now that leads us to the sustainable growth rate. We discuss it here as being the sustainable growth rate in earnings. In equity and corporate finance, we talk about it as being the sustainable growth rate in dividends. Now, if you're using a dividend valuation model, such as Gordon's growth model, and you're looking at constant growth, by definition, your payout ratio is constant over time. And if your payout ratio is constant over time, then yes, your earnings and dividends will grow at the same rate. So there's no inconsistency, in other words. What I should also point out is how to interpret this sustainable growth rate. A lot of people assume that it's the growth that you can sustain only by using reinvested earnings. That's not the case. It's the growth rate that you can sustain without needing to raise any additional external equity. but keeping your leverage constant. So in other words, you can raise additional debt to keep your leverage ratio constant. Now the argument is the sustainable growth rate for the company is the retention rate, the amount of profit we were reinvesting in the company, times the ROE, the return that these additional profits are generating. So retention rate times ROE is sustainable growth. Oh, we've got a question. Firm has a dividend payout ratio of 35% and a net profit margin of 10%, asset turnover of 1.4, equity multiply leverage measure of 1.2, estimate the firm's sustainable growth rate. Okay, well if it's paying out 35%, it's retaining 65%, so we've got the retention rate. And of course we need to use three-stage DuPont to calculate our ROE. So 0.1 times 1.4 times 1.2. So notice therefore that our retention rate is just 0.65. The return on equity is using three-stage DuPont, 0.1 times 1.4 times 1.2, and we get an answer of 10.92%. This firm could sustain a growth rate in its earnings of 10.92%, keeping its leverage constant but without needing to raise additional equity finance. A few little business risk ratios coming up next. Notice these are coefficient of variation, and we've seen coefficient of variation in quants. Remember, it's just standard deviation divided by mean. Remember, standard deviation is an absolute measure, so dividing it through by mean, we get a relative measure which we can compare between different firms. So your coefficient of operating income is just the standard deviation of your EBIT divided by mean EBIT. Coefficient of net income, standard deviation of net income divided by mean net income. And then finally coefficient of sales, standard deviation of sales, i.e. revenues, over mean revenues. It then says what ratios are useful for equity analysis, and looking at that, it's all of them. Look, virtually every ratio is useful for equity analysis. I certainly wouldn't bother learning the list there. Credit ratings and ratios. Now, of course, Standard & Poor's, Moody's and Fitch all use credit ratings and ratios to establish their credit ratings. And of course, what they're interested in is the company's ability to service and repay its debt. So service, pay interest when it's due, and repay, pay down the principal. So they're going to look at interest coverage ratios, EBIT over interest. They're going to look at return on capital ratios. They're going to look at debt to assets, and they're going to look at other cash flow to debt measurements. Now, of course, all of the rating agencies will adjust the balance sheet for off-balance sheet finance. In particular, they'll capitalize operating leases, add them to both assets and liabilities before computing their ratios. Now, segment reporting. Now remember, we said if you're a conglomerate, so you've got many different business operations, the problem is it's very difficult for an analyst to find meaningful firms to benchmark your ratios against. Well, rather nicely, if you are a conglomerate, then you have to use segmental disclosure in your footnotes. Notice, if 50% of your revenues from sales is external to the firm, and at least 10% of the firm's sales come from this division, either 10% of its sales, 10% of its earnings, or 10% of its assets, then we need to report limited financial statement information for each division. In particular, what we need to do is show sales, both internal, intergroup sales, and external with third parties, operating profit, so EBIT, assets, liabilities under IFRS but not US GAAP, capital expenditure, depreciation, and amortization. So, given that information, the analyst could work out a segment profit margin by taking segment EBIT over segment sales, a segment asset turnover by doing segment sales over segment assets, segment return on asset by doing segment EBIT over segment assets, and of course you could work out a leverage ratio as well, but only under IFRS by looking at segment liabilities over segment assets. Last learning outcome here says describe ratio analysis and its use for forecasting. Now, of course, typically what we're saying here is if your common size statements reveal that your common size ratios are consistent over time, then of course you could use these for forecasting. Why? If you could forecast future sales, that would then allow you to generate an income statement. So in other words, you could generate an earnings-driven model using common size statements. By forecasting future revenue, that would allow you to forecast a future income statement. Of course, you have to be a little bit careful here. You would need that common size ratios to be constant over time. If they're very volatile, of course, it's not going to be much use for forecasting. Notice as well, we'll be interested in sensitivity analysis, so how a variable would could change over time. Scenario analysis just looks at the firm's results given best, worst case and probably expected scenarios. And simulation, we look at things like Monte Carlo simulation in our corporate finance. Let's finish off with a question. We've got, what have we got here? Tax rate, equity multiplier, net profit margin and equity turnover. I see those elements and I'm thinking, ooh, okay, probably looking at DuPont. Now let's have a look. Can we do three-stage DuPont? In order to do that, I'd need my net profit margin times asset turnover times the financial leverage multiplier. Now I've got equity turnover, but I don't have asset turnover. So let's have a look at how I can actually compute this. It's going to be 24%. Now, of course, net income times sales divided by equity gives you net income over equity, which is ROE. So if I take my net profit margin and multiply by equity turnover, I will get essentially ROE. So notice that was two-stage DuPont. So 23.92%, and we've rounded it to 24.